Welcome to the Broken Pie Chart Podcast, episode 159. I'm your host, Derek Moore, and back with me is my co-host, well, most of the time co-host, almost all the time co-host, Jay Pestrichelli, CEO of ZEGA Financial. Jay, how you doing today?
Good. I guess if you're going to have a co-host, I'm probably more often than not. Is that probably a better way to put it?
Yeah, well, of course, you do have the most appearances on the show. And
All right.
yeah, maybe at some point we'll just always just co-host. But no, happy to have you back on.
Thank you.
And I tell you what, it's a good time to be on because we have a lot going on with volatility. We have quite a bit going on in regards to the markets and what's going on there. Little bit of a skirmish going on other places, and so let's kind of start with the big news, though. Amazon, Jay, is splitting their stock 20 for 1. They're doing also a $10 billion buyback. Is that a big deal or is that no big deal?
Well, as an options trader, I love that they're splitting the stock, right? I mean, buying one contract of Amazon when it's trading at, $2,000 a share means I've got a lot of notional that I've got at risk, right? What did Amazon hit? 2,700 on the bottom the other day before this announcement. So I love that they split it. It's going to generate a lot of option volume. Now I can include Amazon in a portfolio where I want to manage my risk, all those kinds of things. So I think it's a big deal for the options trader. I did hear that when Amazon does its split, it will become the number one traded stock. I think they're doing 20 for 1. I think that's the number. And so all of a sudden, if you just take their current volume, multiply it by 20, which will be the immediate open interest, it's going to be really interesting and exciting. So from an options perspective, that's definitely interesting. I kind of made a face when I heard the buyback, not to you just now, but I'm just saying when I heard the announcement, I was like, I know $10 billion sounds like a lot of money, but it's not really a big buyback, right? Is it? It's not even 1%, right, Derek, of their market cap?
Yeah, I'm thinking about that because they have their market cap is it's right around 1.5 trillion. So 10 billion, what is that like? I'm doing math in my head. I should know this, about 0.75%.
Right. Yeah. So, okay. Thanks. Right. Great. That's nice. You're giving back a little bit. So that will push the stock up a little bit. But, you get we hear it all the time that no value but increases value from a split, right? Stocks go up when there's a split. There's some excitement around the stocks that just cause some a bullish bias. And we saw it with obviously Tesla. We've seen it with Apple. We saw it with Google with their announcement last month or 2 months ago. So I don't think it's a bad thing. I don't think it adds a ton of value, but as an options guy, I like that now we can, include it in a portfolio if I wanted to use options as a representative exposure.
I think Bob Pisani had a little piece on CNBC that there's data going back to 1980, and this is what he had on there, that stocks who split tend to outperform ones that don't split. He also pointed out that guess what? If you're going to split your stock and not a reverse split, where it's 2 to 1, 3 to 1, 10 to 1, 20 to 1 in this case, like your stock has to have been going up over some period of time to be able to do that. Like nobody's splitting a $10 stock, 20 for 1. Like what's WeWork today? It was like $5 a share. I didn't even know they went public. I guess they went public through a SPAC. But
I didn't know either.
Nobody's splitting WeWork 20 for 1. It's not happening. So, I mean, these stocks already had momentum, right?
Yeah, and I guess it usually is the result of appreciation in stock price. But yeah, I don't. I did hear something that, and I could be completely wrong on this, but now it allows Amazon to give stocks as a bonus, stock ownership as a bonus to their employees at $2,700. What are you going to give somebody? One stock when they're making $40,000 a year. It's a big single bonus. So now I think it certainly enables that too. So I think there's an associate benefit. I think there's a little bit of a shareholder benefit. They're giving back a little to the shareholders. It's hard to think that this is a bad thing. You asked me, is it a good thing? I think in general it's a good thing, but it's not something that makes me go out and buy Amazon stock tomorrow.
Yeah, I'd agree. And there really is no fundamental difference. And if you just take, let's say they earn $10 million a share and they had a million shares outstanding. Well, guess what? It's what is that? $10 per share you make in earnings per share. Is that right? Did I do that right?
Something
10
like that.
million.
Yep.
Yeah, 10 million of earnings, a million shares, you have $10 per share. And then it's like, okay, well, if you split your stock 20 for one, then you have, or 10, let's do 10 for one. Then you have 10 million shares. You still have those same earnings. And it's sort of, it doesn't really change that much. It's not like,
Well, you don't
all
have
of a
the same
sudden,
earnings per share. You still have the same
no,
earnings for the company, but it gets cut by 10x, right? So it's a dollar, right, in
right,
earnings per
right.
share.
So your earnings
Yeah.
per share go down, but you still have the same earnings. Like the company is still making the same amount, and all those sorts of things. So, yeah, I don't know. I agree with you on the buyback, though. And obviously in that same example, 10 million of $1 million in revenue, a million shares, you buy back half your stock to 500,000 shares. Now you go from $1 per share EPS to $2 per share. Anyway, enough math there, Jay. Yeah, I agree. Not that big of a deal, but it used to be a bigger deal. Do you remember when like what was it, late 90s? If you split your stock, all of a sudden because of the commissions, people could buy more shares with the same amount of money. And that was like a big deal. A lot of people wouldn't buy stock because like, oh, what am I going to buy? 3 shares and only, I could pay $200 in commissions, right? So I tend to agree, Jay.
Yeah, those days are gone. But there's always some excitement when you're splitting the stock because then it just feels like, oh, I got more shares, right? I don't know, right? There's a little psychological benefit there, but again, fundamentally, no benefit. We've hammered that in pretty well, I think. But like you said, good stocks split their stock, bad ones don't. But at least they don't split them forward; they reverse split them, right?
Yeah, that's a whole other conversation. I will tell you that back in the day when people used to get physical stock certificates, every now and again somebody would find certificates in an attic or something, and these certificates might have been 50 years old. And I do remember somebody came in with a physical certificate. I think it was Coca-Cola, and they had a certain number of shares. And they look and they see the price of Coca-Cola, and they say, "Okay, well that's pretty cool. Maybe I have 200 shares at $30." But when that stock certificate got put into the transfer agent and then reissued, they had to reissue it at whatever the split adjusted shares were. And I remember this one person came in, found it in the attic. 50 years ago, they bought it. I don't know how many splits there were, but it was quite a bit of money. They were pleasantly surprised to understand what happened there. But I don't think anybody does physical stock certificates anymore, unless you buy Disney. You still, I guess, you have the mouse ears on the stock certificate, right?
Well, yeah, and then you frame it and you put it up in the baby's room. Like I don't know, you didn't do that for your son. I think we did it for mine. I think we still have it actually.
Yeah, he owns Disney in his his small account. Don't buy Disney just because I told you, not a recommendation, of course. But yeah, no, he owns it. But I like the fact you actually bought the shares, Jay. That's smart.
I got the shares, I got a certificate, and I get like a 50-cent check every quarter or 30, something for the dividends. I don't know if my wife actually deposits that. There's probably a big stack of them somewhere.
That's going to be like the Seinfeld episode. What was it? The show he was on, was it in Japan? And he gets these little checks, and he used to hurt his hand trying to sign all the checks. I don't know if you remember that episode, but all right. Well, speaking of checks, let's check a couple other things too. And we just talked about share counts and those things. What we're seeing in the markets is, I don't know, I think it's kind of interesting in that what the market is willing to pay for every dollar of earnings has shrunk. And not only did it shrink last year, it is shrunk. Hopefully, I'm using the right tense there. This year as well, Jay. I think I mentioned earlier that year to date earnings are up. Now these are the fourth quarter earnings being reported now, but they're up a little under 3%. But people are willing. We think about the PE ratio. How many times earnings? Like if you have a dollar of earnings and it's $10 a share, it's trading at 10 times. Jay, minus 13.6 multiple growth this year. So people aren't willing to pay the same amount. And I think maybe it's constructive to think about like, okay, so when you're watching TV and you hear these really smart people come on and they're trying to make, estimations of the future. I mean, what are some of the areas that they're trying to figure out? Like what goes into the earnings and what goes into the stock price movement, right?
Yeah, it's almost like there's two ways that I like to think of where the market reflects its emotional bias, right? We know the market is emotionally driven, right? Fear and greed drive the market. When people are greedy, you could almost equate it to a higher multiple. When people are fearful, you could equate it to a lower multiple. Derek, I think the term you were looking for instead of shrunk was contraction, maybe. Maybe that's the term
Sure.
that they use. Sure.
That's a better word.
Uh, and so, yeah, so multiples have contracted, which tells me that, there's less optimism for the growth of the stock market because people aren't willing to pay as much for the earnings that they're planning on getting. And so that contraction is really interesting. It's just one of those things that should follow. So even though companies are making more money, the stock market is down, right? So there's one of the things I always say, that the things that drive the market are corporate earnings and interest rates. Well, being willing to pay a little less for those earnings can cause the result of a lower market. And so, yeah, that's kind of I'm not sure if I went off on a tangent there, Derek, but that emotional disposition of the market can definitely be reflected in the contraction of the market multiple.
I was listening, Jay, to another podcast where they were talking about this investor letter. And it's a Semper Augustus investor letter. So this looks like to be a fund or a hedge fund. And what they did was they broke down these different 10-year periods. And I thought it was interesting the way they did it, where they said, okay, if your revenue goes up, okay, that's good. That's good for companies. The other part of that is how much you make on every dollar of revenue. So if you have a 10% margin on $1 million, you make $100,000. And then you look at that and you say, all right, well, what else goes into the price of a stock? All right, well, we know we eventually come to earnings per share, but it's what is on the total return basis, what is it paying out on a yield? And of course, buybacks are a quasi dividend, but this is just a pure dividend. And then the share count. And we mentioned early on how many shares there are. So if companies buying back their stock, that reduces the share count, increases the earnings per share. But that multiple, Jay, I think margins and multiples definitely move around. To give everyone an idea, looking at 2012 all the way through the end of 2021, the PE multiple was 23.6. So people were willing to pay 23.6 times. But if you go back to, let's say, I don't know, the 99 to end of '09 period. So, that's year 2000, full year 2000, all the way through the end of 2009. Well, what happened there? In there, it was a re-rating as well. So the multiple dropped from 28.4 to 19.6. I'm not going to keep throwing numbers out, but the point is people were willing to pay less for stocks. That was a lost decade of stocks. Your annual return was pretty much a little bit annualized, less than 1% a year. And margins went down as well. So, Jamie, just thinking about looking forward, I mean, people should be listening and watching. Are revenues going up, right? Margins, are they changing? And I think that impacts a lot. But I think it was just, I don't know, to me, it was interesting to think about. Yes, earnings going up is obviously good, but there's more to it, right?
Yeah, there is a little more to it, and you've laid those main metrics out, right? So end revenue, which is partially driven by shares and your efficiency, how many shares you have outstanding, your yield that you're paying back investors, and then whatever the multiple on that is, that kind of drives it, right? So those are kind of the main data points that kind of go into the corporate earnings side of market projections. And yeah, and in that decade you mentioned, the lost decade from really the end of '99 to the end of '09, let's maybe we'll just say 2000 to 2010, market revenue grew, like sales were up, right? So it's one of those things that it's not always the top line revenue that matters, right? It's how much you flow to the bottom line, and it's one of those things that uh, that multiple contraction can matter on the end result. So it's a good point, and we are, as you mentioned, last year we saw multiple contraction, even though the last decade we've seen multiple expansion, meaning that multiple has gone up. Um, I guess the question is, do we get more multiple contraction in today's environment with where things are going? I guess, how do I take that data from all this history we've just quoted and, and work it into my next investment that I make? And, when you think about it for today, um, it's hard to see a reversal in that multiple contraction in the near term future. And again, not making a prediction on where the market's going to go, but I think investors are going to start to become a little more picky about how much they are willing to pay for stocks.
I think it also goes to the point, for a long time, we saw people come on CNBC and say, the market's too expensive. The market's too expensive. We're way out of whether they use the CAPE ratio or the Shiller PE, right? Or they use just a strict forward PE ratio, which is not trailing earnings. It's based upon estimates, and estimates can change. I mean, they were around 23, I think, 20. I don't think they ever got to 24. That was not that long ago. And as of the close yesterday, the forward PE was, I'd say, only 18 and a half. And they'll remind you that the 25-year average was 16.85%. So we're getting close to the 25-year average. I guess the question is, too, I mean, earnings are an estimate. Does all this stuff that's going on, whether it be interest rates, whether it be the Fed making some move to try and combat inflation, the conflict that's going on overseas right now. I mean, those are all things that could play a role in earnings. I guess margins here are something to watch. Like, can companies continue to pass on additional cost into consumers? I don't know, but that's the way I look at it, Jay. I'm not sure if you're thinking the same way too.
Well, you just hit on a couple points, right? You jumped to the answer, right? You talked about margins being impacted, probably because you're implying that inflation is higher, right, due to what's going on in the world these days. And then what the Fed does that potentially reduces sales, right, or top line revenue, right? Those two things that exist today can definitely impact the end result on earnings. There's no doubt about it. And the willingness for the consumer to continue to pay higher rates at some point will get stretched. I'm not sure we've had it yet, but starting to feel that way. I a data point of one here, that I think we probably got to touch on is filled up my gas tank the other day, right? And I have a 23-gallon tank on my SUV, and guess what? The pump stopped me at $100, and I wasn't full yet, right? So it's like, oh yeah, that hasn't happened to me since 2008, the summer of 2008, when
Wow.
gas got about $5 a gallon. So yeah, like we're going to start to see some demand destruction from higher rates. So can it hurt revenue? Yes. Will inflation hurt margin? Yes. Will the Fed also hurt revenue? Yeah, they need to slow the economy down. So all of those things seem like, probably justify why investors aren't willing to pay or why they want to pay less for stocks, hence lower PE ratios.
I wonder too if, well, it's just on inflation too. I think it's what I love about the markets as well is everyone could look at something that's really obvious. Like this, what you just described seems pretty obvious. And then markets continue to surprise. I mean, we know that predictions are often false. I mean, that's why our sort of mantra is you stay invested. We know that missing even the best couple days in the market considerably hurt returns in the long run, annualized returns, right? So we just buy and hedge. I mean, that said, I wonder too, like inflation, this isn't a surprise. Inflation has been high for a while. But JD, don't you think that maybe people's expectations on longer run inflation are going up now? And it's the experience you just described. Like people are filling up their gas tanks and like, wow, this is grossly expensive now compared to what it was. I don't know how much that impacts things, but the excuse of, hey, once COVID's over, prices will come back down. I don't think that holds water anymore, right?
No, it definitely doesn't. Right, the supply chains haven't repaired themselves yet. Right, we're still, you know, grocery stores and other stores shelves are not full, and now you've got this added cost of food, energy, and materials from what's going on with Russia and the Ukraine, and those may not go away even after, like, I think if after this Russia conflict resolves itself, I I think we could see $100 barrel oil for a long time, and that was not my opinion before 2 weeks ago or 3 weeks ago. We thought, well, there's going to be a little bump here in the road, and that'll iron itself out. But now, the sanctions that governments are talking about, you're going to start to take, Russian oil off the market, and all of a sudden, you go, okay, oil's going to be higher for a while. Uh, Derek, I think you told me this, right? The Ukraine is one of the largest wheat providers in that part of the world, right? And to Africa. Well, so there's still going to be a problem, right, after this is done. So I do think it's going to be here for a little while. It's not. It certainly isn't transitory, and it's at this point, no one's even really talking about how is over and inflation should go back to normal. That just doesn't seem like it's in the going on in the dialogue these days.
I think you're right, and I'm always reminded of the fact that taking us back to maybe 2008 and what people said versus what actually happened. And I think a lot of times, whether it's someone going on CNBC or a Fed official, like, you can't say I don't know. So I remember ex-chairman Yellen saying, hey, I don't think there's a problem in housing. A couple of years later, I'm not calling her out and saying, but it's just the nature of it. So when you had people coming on and saying, look, I mean, supply chains, once we get the shipping, once COVID's over, people start spending money on more experience-based things. I mean, this is, we've had these external factors that continue to provide no relief for inflation. And I think one of the things too, we know that inflation never goes away. In other words, the inflation that we have right now, the rate of change will slow, hopefully, but over time it goes up. But once you have it, like when we had high inflation in the late 70s, early 80s, it's not like inflation was negative 20% for 3 years to get rid of all the gains. So it's sort of embedded now. I don't know. And I think for me, and maybe we can talk about this for a second too. There's no oil that's coming on like tomorrow. And I think I was listening to some experts talking about, that there's to get a rig up and going and to drill and to explore, they've got to invest money. It takes time. Um, so yeah, we're sort of at where we're at right now, right?
Yeah, no, I think that's right. I think your point about how inflation not going away, I do think it's one of the reasons why they strip out, food and gas from the core CPI, because it is sticky. Gas, we know, could change, right? I don't expect gas to be $5 a gallon next year, but it could be for a little while, right? And like I said, it's been since '08 since I paid $5 a gallon, so it can, go down, but I think it's just with those more, I'll say, more sensitive products or more sensitive classifications where it can go back down. But you're right, like, there's it's the cost is going to be embedded in it, and it'll be there. And so what's the eventuality there? Wages are going to have to go up, right? Wages haven't really kept up so far, and I think that has been a little bit of a piece of optimism for the people that I guess I'll call them the inflation bears. I don't know what that is. If that's someone who doesn't think inflation is going to be around long, but like, hey, wages haven't really followed yet. But we've got how many job openings was on the JOLTS this past week? 11 million, right? That's like a crazy amount of job openings. So employers will have to pay more. So yeah, it's here. It's going to be here for a while, and I'm not sure the Fed's going to be able to do anything about it at this point. By the way, if they raised rates 6 months ago, I don't think it would have mattered anyway, right? Everyone's all over the Fed about letting inflation go too long before letting QE roll off and before raising rates. it feels like at this point it wouldn't have mattered, right, with what's going on in the world right now. Not sure I've said that to anybody yet, but there you go. I'm throwing that in there.
No, I agree. And to further on your point, because I don't believe that it's an interest rate issue right now. I mean, we had low interest rates for a long time, and some people might be like, we knew this was going to happen, printing all this money for years and years and years. It didn't happen when a lot of people said it would. But the difference this time is the fiscal side. Like it rather than raising rates, the US government would almost have to say, you know what? We send all that money out. We put all this fiscal stimulus. Fiscal means stuff that politicians and Congress and Senate, they approve and they put out, like when they sent the checks out. That was a massive delivery of a pretty high percentage of our GDP that got, put into the economy. So to me, like you would almost have to have a fiscal response where they reversed that and said, hey, everyone has to send us money now. Like we need to take money away off the consumer balance sheets. It's not an interest rate thing. So maybe that's just a different way of saying it, Jay, but that's the way I look at it. And I think you're 100% right.
Yeah. Well, they could do it with taxes, right, Derek? They'll get it back by raising taxes.
Yeah, I mean,
Maybe I
well,
shouldn't even go there on that one, right? I think we should probably expect higher taxes versus lower taxes, but that's not a topic I think we want to touch on today, right?
yeah, but all this does play into the calculus of, okay, what does it do for the demand side of the economy? And if you're doing things that are going to hurt demand, it could be raising rates, it could be raising taxes, it could be tariffs, it could be any number of things. And there are a number of things that could help that. So, I mean, oil is definitely a tax on the consumer. And oil is not something, remember in economics class, it's inelastic and elastic goods. Like people generally, maybe on the margin, but if somebody has to fill up their tank to go to work every day, they got to fill it up. There's no, you can't switch to something else. And by the way, Jay, I did want to mention that on an inflation adjusted basis. So I think this is, some people are a little crafty. I'll say crafty. I don't want to say deceitful because they're not being deceitful. But there's this thing in our world where people put up a chart or they quote numbers, and sometimes they're adjusted for inflation and sometimes they're not. And the price of oil, what I did was I went back and I said, let me look at the WTI, which is West Texas Intermediate. And I'm going to look at it since 1970, every month, the end of the month price. And then I said, let me put $120 a barrel in here. And let me adjust all the previous prices to today for inflation. So this is priced in 2022 dollars. And 120, it's not past the peak in 2012 and 2013. It's not past the peak in 2008. And believe it or not, it's actually not past the inflation adjusted peak in late 1970s, 1980, which just goes to show you, Jay, that 1980 period was a massive increase in oil. I mean, that was bad. But I don't know when I did this. I mean, I know you knew this in your head, but when I put this out in the graph, I'd love to get your thoughts on it.
Yeah, I mean the equivalent of what happened in '08 of being, would you say, close to $180 per barrel. I think I remember it actually trading at the time at like 145 or something like that, right? And so it does help put it in perspective that, hey, we're kind of, yeah, this is kind of high, but you're really running at the same rate that you were running in, 2011, 2012, 2013, 2014. I think those are all like pre-fracking years, I think. But just gosh, I don't want to take us political on this at all, right? But I do think that there was a lot of supply that came in and kind of brought us down from there. But we're just approaching the average of that 2013, 14 range of what we saw for oil. So I think it's interesting to keep it in perspective. That it'd be interesting to see the gasoline adjusted, but still, because that's really what affects most people, unless you're paying for oil for your to heat your house. But yeah, Derek, I think we're below the last couple peaks right now, and which is why it doesn't. It's what, to me, it doesn't feel like it has to retrace back down to $60, $70 a barrel. I don't think we should probably expect that anytime soon because it's not excessive right now. So I'm with you. I think I think it's a great piece of data that you put together.
Yeah, you know what? At some point I can pull the gas. It gets a little. Um, so what
Seasonally
a lot of people,
adjusted, all that kind of good stuff, right? I know
yeah,
it's
but
tough.
also like the price of a barrel of oil, although there could be tariffs or things in there. Really, that's a little more pure. When you look at gasoline, like California has $1 per gallon, between all the taxes they charge, and not every state does that. So
Yeah, that's
uh,
true. It can throw it all off.
I will tell you though, and while we were talking, I pulled this up. The EIA, which is the U.S. Energy Information Administration. I didn't know what that acronym, off the top of my head stood for. So now everybody knows. It is interesting. I mean, in 2019, I think it was December. No, actually October. That was the first time we'd ever been a net exporter of oil. Going back. I mean, I'm going back on this chart back to the early 1970s, and I know I've seen it further. And I mean, so anyway, I mean, I just think that's sort of interesting as well. And leaving off the discussion about what should we do with regulation or all that stuff. Our capacity was going up, and to just think, I mean, every U.S. presidential candidate going back to when I remember in the 1970s, I remember their campaign promise: we're going to become energy independent. We're going to export our own oil and all this stuff. Well, it never, it never happened. It finally happened, in 2019. So I don't know. I mean, the laws of supply and demand still apply, as to quote Chairman Powell in his congressional testimony. So, we'll see kind of what goes on there. But Jay, I want to transition, and feel free to chime in anything else on that. But this volatility regime that we're in. You and I obviously are in the volatility space with options, and we sell volatility for some of the strategy. We're long volatility in other strategies, and we are seeing a regime. I'll call it a volatility regime that's starting to remind me of 2008, 2009. So maybe just start there, Jay. I mean, talk about the VIX, the levels you're seeing, and then how long it typically takes to come down. Why don't you start us there?
Okay, yeah, for sure. So, using the VIX, the volatility, SIBO's volatility index, quick definition on it. It is the implied volatility over the next 30 days as defined in the S&P 500 options. So essentially, it looks at the premium and the implied volatility in the individual options between now and the next month. And then it says, okay, the options market is predicting this amount of volatility over the next 30 days. And today we're trading at about a 30 VIX, that kind of range. And what that implies to us is that, hey, and that, by the way, the average, long-term average is more like 20. What I would say is that when the VIX is when it's higher, it's implying a higher move. So higher VIX means higher volatility, which means higher moves day to day in the market. In general, that usually means down days, right? I always say the markets climb upstairs but fall out windows. I stole that for sure. I didn't make that up, but it's true. So when you expect bigger single day movements, it's usually because the expectation is bigger drops coming. So the VIX is kind of that volatility index that typically insinuates higher fear in the market and higher risk. So that's kind of the definition of the VIX. Let's just use VIX as the volatility index and the fear index, although I think I gave it a little more detail than that. Now, you just mentioned '08 to '09, which had some very high volatility, but we saw the same volatility in 2020 with the COVID fears. So, it's interesting when you look at volatility. We just talked about it, or I just mentioned that it's only a 30-day outlook, right? It's a 30-day outlook. And, it's one of those things that doesn't predict years and years, certainly not, single year performance. So, the question then becomes, how can volatility kind of be higher, and what can you learn from that? And I think what you were insinuating with the 0809 was that, hey, volatility was up for a while, right? It wasn't just a pop in the fall of '08. It was up for a while. And when you actually look at it, volatility, if you like were to expand out a chart of volatility of the VIX through like monthly VIX by 20 years, right? You'll see that volatility kind of goes through these periods of being elevated and periods of being depressed. When you look at the '08, '07 period, volatility didn't go away after the financial crisis was behind us. Volatility stayed in the market really till about 2013. So about a 5-year period, we had higher volatility. Same thing happened in the lost decade, right? Starting in the 98, 99 period, volatility lasted into 2003. Again, a 4 or 5 year period where volatility was just elevated. And the periods between that, it's low. Like vol is low, VIX is below 20 almost all the time. It's just a smoother chart. So, what does that mean for where we are today? When I think about where we are today, volatility was low going right into the end of 2019, even the first 2 months of 2020. Of course, we had the COVID issue hit. Should I call it an issue? I guess it was a pandemic. I'll give it its due. COVID hit and volatility has gone up, and it has not retraced. Even though last year was a pretty calm year in the markets, volatility, as measured by the VIX, remained high. So I would say that we are in the second, just starting the third year of a potential 5-year period of higher volatility. So I will pause there, Derek, before we talk about what does that mean to investing. But I'll shut up there and let you comment on that whole thing I just gave out.
One of the things I was going to ask too, and maybe you'll go into this and you can just go into it now, is the idea of what it means. Like, does this mean that people still, because I remember in 2009, like volatility stayed high even after the danger was done, and it stayed high for a while. But maybe as you transition, think about that too.
Well, yeah, no, that's what I'm saying. Like it stays high for a while once it's really become entrenched, right? And we've had a high volatility for the last 2 years, even though gosh, I don't want anybody to quote me. Jay said COVID's behind us, but it feels like the impact to the market is behind us for now, right? The COVID stuff has had its swing at giving us quick 5, 6, 7% declines, but it feels like, especially if you look at the way 2021 performed, the market is, the market is over COVID. Um, but now we've got what's going on here in the world, whether it's inflation or it's this conflict, Ukraine and Russia. These issues will get exacerbated, or I should say, the market reaction will be exacerbated when there's a higher range of volatility. And so it's here, it gets embedded. Investors, mostly traders, by the way, expect bigger moves. I think you just said this just 2 days ago or 3 days ago, Derek. The S&P was down, I don't know, 30, 40 points, and it was a 0.5% decline day. And you said, well, that felt like a flat day. Well, you take that day and put it into 2017 or 2021, and you go, whoa, can't believe the market was down 0.5% today on no news, right? So it kind of builds on itself, and traders it'll perpetuate for a while. So even if we got inflation behind us, even if we got COVID behind us, historically speaking, volatility will be here for a while. I think it's probably fair to say that the Fed raising rates is something that's going to naturally keep volatility up. Markets tend to do worse in the years when the Fed is raising rates than when they're not. But I think that's probably it as well. So I do think we should expect volatility for quite some time. I think at least a year, probably another two.
Well, I like the way you put it too, and for the audience listening, it's not that COVID or all those things. I mean, we had a lot of other people commentate on that, but it's what people are fearful of. And I'll give a less recent example. Greece, the country of Greece, was thought to have been on the verge of defaulting, and we saw implied volatility. We saw volatility react to that and be embedded into the market. Do you know today that Greece is no longer anybody's talking about Greece's debt to GDP. It's higher than it was. I think that was 2012, right? Probably somewhere around there. I don't remember where, CNBC was live in Athens and you saw the protesters in the back and they were in front of the ruins and everything. And so it's not that these things don't matter. It's just the market being more afraid than they already are. And when the market stops being more afraid than it already is of these things, we see the volatility being less impacted. Again, nothing's changed in the debt to GDP levels in Greece. Sure, the eurozone has done some bailouts and different stuff, but I mean, we always say things matter. Like for example, I thought the rising U.S. debt was a problem in the 80s. Apparently, I was wrong. That's not an issue. Every year people bring that up, and it matters when it matters, right, Jay?
It matters when it matters, right? When all of a sudden the market wants to pay attention to it. I couldn't agree more with you. And until then, it doesn't matter. I mean, which is kind of silly. Which you know, it gets back to why trying to time and guess what the market is going to do based on the circumstances that are going on can be really, really difficult.
So think about, we've explained the volatility regime, if I would say that properly. And we talked about maybe how it tends to stick around, it goes up. I mean, the spikes tend to retreat, but the overall, hey, we're in higher volatility. I mean, I don't know about you, but I don't think we're going back to a 10 VIX anytime soon. And maybe, think about, so what does it mean for on the as traders? What does it mean for investors? How should people be kind of framing this type of volatility regime?
Well, yes, no, 10 VIX is not, I don't see that coming either.
Not happening.
I don't listen. I no guarantees here, right? But I'm not counting on the VIX getting there anytime soon. So yeah. So what does that mean for us as traders? Well, as you mentioned, we have some strategies that are long volatility, some that are short. Strategies that are long volatility, it gets more expensive to put on things like hedges. When you're long volatility, it means you're in a position that would benefit from more volatility, which typically means market going down. For us, that means hedges. So hedges are more expensive. But on the flip side of that, we do have some, we run some other strategies that are short volatility, which harvest this volatility through by the means of selling option premium, right? And so when the market is more fearful, meaning higher VIX, higher implied volatility within the options, selling options becomes potentially more lucrative because you're able to kind of capture the fear that's reflected in the options chain that I mentioned before when we talked about multiple expansion. The other way that I think emotion is represented within the marketplace is the implied volatility of options. Somebody who's willing to pay $1 for a 1% move today, last year, and today they're willing to pay $2 for a 1% move. They've got to be more speculative. Means the market, they're going to pay a lot more for that market movement. Maybe I'll use another example. Maybe instead of them paying the dollar for the 1%, they pay $1, but they got to get a 2% movement, right? So when option prices go up, that is when we look to harvest that volatility, and it's pretty unique, right? There's not a lot of firms out there that are that have strategies that the predominant rate of growth is premium selling. There are some that do that, sure, plenty of them. We've been doing it, 10, 11 years at this point in the firm. And so it's one of those things that in an environment like this, having protection on is great, but taking advantage of that volatility is definitely something that you can do as a premium seller of options. Now, seller beware, right, when it comes to that, because you're essentially the seller of insurance. So while I say we've been doing it for 11 years, it's not like the strategy hasn't had its lumps. Everything does. It still persists and it does well, and it's one of the most asked about things that we do. But things could get nasty sometimes, right? When you're selling volatility, essentially selling puts, when that happens, you're the insurer. And what is the thing the insurer never wants to do? They never want to pay out on the insurance, right? So it's one of those things that I'm not hopefully I'm not encouraging everybody to go out and start selling puts, but uh, it's just one of those things that while you have higher volatility, well, you have higher vol, then it's you should be able to take advantage of it if you have that ability.
I'll mention to people too that anyone wants to learn a little more about how we sell volatility and do some of that, Derek.moore at ZEGAfinancial.com. That's DEREK.MOORE at ZEGA. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly. Jay, on the VIX level, I know the VIX is different from the implied volatility, let's say on the S&P 500, but it's a pretty good proxy, and they tend to converge and be close, at least on the near-term option chain. When I look at the VIX at 30, I always come back to, and there's actually 251 trading days this year, and the square root of that is 15.84. I shouldn't say about. I just did the calculation because I think it was
Yeah, like
251.
what about? You're going to go 3 more decimals to get it exact? I
Yeah.
think you
Well,
got it.
I know the
It's
square
fine.
root of 252 for years. It's been 15.875 rounded, right? I know that. And then we have the rule of 16 the traders use on the floor. So essentially, if you take a 30 VIX and you divide it by that 15.84, you get 1.89. Basically, that VIX is implying a one standard deviation range of about 1.9% on any given day. Jay, I don't know. Some days the markets have moved, about that. But I mean, wouldn't you say it's probably fair given where the market has been moving of recent? And then maybe, we can talk a little bit about selling volatility is all about the implied volatility and getting paid more than actually winds up being, happening. It's kind of like buying insurance or selling insurance, and then the car gets driven all day long and comes back looking no worse for the wear, right? So, but I think let's maybe start on that sort of calculations in our minds of, is that fair given where markets have been, Jay?
Yeah, it's a really good point because a 30 VIX says the market is expecting the S&P to move 2% that day, right? That's when you say one standard deviation. So break out your stats book, everybody. I know Derek has a picture of the bell curve, the standard deviation bell curve, right on his cabinet there, and he looks at it every day. I'm kidding. So break out your standard deviation books and realize that that's about 68% of the time, at least one standard deviation occurs. And so think about that. That's the market is telling you with a VIX of 30, like, hey, we expect almost a 2% move every day, right? So that should happen, 3 out of the 5 days this week. That's what we're expecting when we see a VIX of 30. And listen, I will. I'll quote yesterday and I'll quote today. So this is 310, 311 are the days I'm talking about. The market was down 1%, and the VIX went down because the market didn't move more than 2, right? So typically I mentioned before that the VIX goes up when there's more fear. Usually when the market goes down, that adds to more fear. So the VIX usually goes up. So does it feel right? Yes, Derek, that, expecting every day to move 2% is probably what we should expect. It also tells you that you get the dreaded 2 standard dev move every once in a while, right? So one of the things that really makes people go wow is when you have, and I'm making air quotes, a 2 standard deviation move. That's a real thing in our business. People talk about the day that you move more than 2 standard devs. Well, what that means is you had something occur that had less than a 5% chance of occurring, but it occurred anyway. Today, if we got a 2 standard dev move, it would be about a 4% move in the S&P. That would probably open some people's eyes. But 1% move these days, everyone's like, well, yeah, things are bad. I guess we're going to move 1%. No one's really blinking an eye. So putting it all in perspective, again, that VIX is predictive in nature, but it is not exact either, right? What the VIX predicts isn't actually what always happens. It's just the way that the options market is reflecting those predictions. And the options market is a reflection of real dollars at work, right? So it's not somebody's guess. There was somebody that placed a trade that caused implied volatility to go up, which causes the VIX to go up. Those kinds of things, real dollars into the market imply this predictive move. So anyway, I think I probably went off on a little tangent there on you, but you and I always talk about the dreaded two standard Eve days, right, Derek?
Yeah, absolutely. And it's all about, realized versus implied. But yeah, I think I agree. This is going to be, this regime will be around for a little while longer, if not for some time. And maybe we'll save for another time getting into implied volatility on interest rates, which is higher now, especially given the Fed move. Jay, just want to do a couple of quick hitters before we wrap up. Number one is the given where oil prices have gone and energy is a component in the CPI, do we actually see CPI year over year when it gets released in April, the March numbers, crest 10%? I will tell you that the inflation nowcast, which is just, hey, what's all the information I have right now? And that will tend to be more predictive the closer you get to an announcement. That's saying a 1% month over month for March. And what is this, 8.2, 8.3% CPI for, year over year. So I don't know. I mean, maybe. Any thoughts?
We're already at earlier this week, actually, right? We saw the Fed number come out, and it was what, 7.8. That was the kind of the official CPI number this week. To stretch it to 10, we're already at 40-year highs on inflation. Listen, I think it's possible, considering what's gone on the last couple of weeks, and the ripple effect of oil, wheat, nickel. We didn't even talk about nickel. We don't have to if we don't want to. But all of those things that are kind of going on in, increasing costs. It may take, Derek, an extra month for that to ripple to the actual consumer. But maybe PPI sees, the producer price index sees it first. But man, it's hard for me to get behind a 10. But I think that's a nice headline number to get people's attention. Like, will we see 10? I think you got to consider it. I think the market will not like it, by the way.
No, that would be problematic. And to remind everybody, when you're doing year over year, now the March of this year, which is 2022, now has to get compared to 2021 March. So, the comparables keep going up. It's like same store sales. If you go up this year, then next year you got to compare it to a higher rate. So that might stop it from going up that high. But
Yeah, it's just the
we'll
law
see.
of large numbers, right? Because inflation is a rate of change, right? So does the rate of change continue at the same pace?
And then I don't even know if we should do a contrarian corner this week because I had a bad beat. In other words, I think it was a couple weeks ago. Was it 2 or 3? It was probably 3 weeks ago that I said, "Hey, my contrarian trade would be to go long emerging market value." Oh boy, was that a bad call, Jay? And we did say, we always say, don't trade on this. We're just kind of doing a little like if you were going to be a contrarian, like what's an unloved portion of the market? That was a bad call. Throw a flag
Well,
on that, Jay.
yeah, look, actually, I'd like to. So let's let's find the silver lining in this. So, like, if you actually had placed that trade, one of the things we always say is, use your, exercise your inner guru if you want and take these flyers on and be a contrarian, but you should still hedge it, right? So if you were hedged, you're willing to kind of take that kind of a risk, but you limit your risk, right? So that's the only thing we could really control is the amount that we risk. And so when we have wrong calls, which we all make them, including myself on the contrarian corner, the very first episode, I think I said, this inflation thing's going to be behind us and you don't want to buy commodities, right? I don't think that could have been much more wrong either. Again, it's a good thing we don't have to make those calls for us to make money for our clients, right? But if I did make that call, I would have hedged it. I would have used options and I would have protected it. So yeah, we've both had some bad calls, but the good news is we would never do that without having some sort of a hedge on.
Yeah, and that goes to, we start out the program talking about the whole idea of multiple ratings and things like that. And one of my basis was a re-rating the multiple higher. I made mention that a lot of these emerging market deep value companies, some of them were in Russia, some of China and Brazil, different parts of the EM landscape, and I think that re-rated down, the opposite of my basis for it. So, I mean, the PEs on those, I think, are back to like 4.7 or something like that. And I didn't say which ETF, doesn't matter. I didn't want anybody to do what I was going to do. But yeah, I mean, that's down 10%, over 10%, I think, since then. But I don't know. Do you have a contrarian play this week, or should we wrap up? If you have one, let's hear it, though.
Listen, it's so well. What is the general accepted market bias right now? I don't think there's anything to say you're really going to be a contrarian on, right? You've got rates, right? The Fed came down with the expectation of 50, but they're just probably going to go with 25, and that was one that I think they're going to take their time on. So you can't really tell. Do they still have to do 7? So they're just going to slow play it? I'm not sure. Markets going lower. I don't know if this is contrarian or not, right? But I'll say this: like I like buying the markets at discounts. It's part of the reason why we hedge, right? To preserve capital and then reinvest while the markets are lower. I don't know if this is a contrarian call or not, but I still believe we end the year higher. I still believe we end the year at over a 5% gain, in that 5,000 mark on the S&P. I don't know if that's contrarian or not. I'm not sure where everybody is, but that's where when people ask me, Jay, what do you think? I still think a lot of the dynamics and a lot of the pieces that were in place at the beginning of the year still will eventually push stocks higher through the end of the year. I don't know if that's contrarian or not, Derek. That might be not contrarian.
Yeah, I don't know. We do have the midterm elections. I know Spencer and I'll have him back on as a guest. We'll do our way too early midterm election prediction podcast that we did during the presidentials as well. But I'm looking at the numbers here. So what's the S&P as we're recording? Around 4250?
4230.
4230. Yeah, so that's roughly, it'd have to get to 17% from here to get back to 5,000. Is my math right there? I think my math's
right. Around there, 18%. Yep.
So, if it went to 5,000 year over year from the end of 21, that would be what, 7% gain from last year?
Let's say we closed at 4,800, right? That's kind of about where we were, right? So 5,000 divided by 4,800 is about a 4% gain.
Yeah, okay.
For the year.
So there you go.
So maybe I'm not really being a contrarian. That's actually pretty vanilla.
Well, the total contrarian trade would be I haven't looked at the price of nickel. People can Google what the heck happened there. But maybe short commodities. I'm not saying anybody should do that, but it would be a contrarian play. Or
I got burned on that one earlier in this podcast.
Yeah, well, don't frown, double down, and maybe go back and take another look at a sprinkle into that or emerging market value. But
there you go.
Don't do any of this.
Get back in.
Don't do
hedge
it. Stuff. Yeah, just hedge it. Use like 1% of your portfolio and the rest in hedged equity. All right, Jay, I think we'll call it good for there. We'll be back probably maybe next week, maybe not, maybe the week after with you again for another episode. So remind everybody, great. What holiday do we have? St. Patrick's Day. If you're looking for gifts for St. Patrick's Day, why not buy and Hedge, Jay Pestrichelli's book, or Broken Pie Chart, my book, both available on Amazon. I mean, who wouldn't want a St. Patrick's Day gift like those two books, Jay? I couldn't think of anything better.
I mean, they make wonderful coasters for your beer and your corned beef and cabbage. It's great. Just put it right there.
There you go. Better than a coaster for St. Patty's Day. Jay, thanks again for coming on. We'll talk to you soon.
Thanks, Derek.